Hello and welcome to the CNBC TV 18 special. We're coming to you from Kolkata from the headquarters of the RP Sanjiv Goenka Group. I'm Shireen Bhan and we're in conversation with Sanjiv Goenka. Mr. Goenka, thanks very much for joining us here on CNBC TV 18.
Hi Shireen, always a pleasure.
Well, thank you very much for having us here. Let me start by asking you, sir, about the targets that you've set out for the group, and a fairly stiff one at that, 40,000 crore rupees over the next 5 years. And specifically as far as the FMCG business is concerned, from the current 500 crores, the target is 10,000 crores. Are you on track to be able to deliver on these numbers?
Well, I think we were hoping we would be at a beat rate of about 600 crores, and we are at a beat rate of 500 crores. So we are slightly behind on that. But we've got some very interesting new products ready for launch. In the space of snacking, guilt-free snacking, we hope that by the end of this year, we will launch our next category.
Okay.
And a lot of work is going on and some very interesting products which are emerging.
So this will be the 2Yum brand or a different brand altogether?
Maybe a different brand.
Okay.
But I think as far as the 5-year target for 10,000 crores is concerned, I think we are very much on that target. And we're fairly confident of getting there.
Okay. How much of this, 500 crore to 10,000 crore journey is going to be done organically, and how much of it is likely to be driven by inorganic growth? You have done some acquisitions already. Do you have appetite for larger acquisitions to get to that number?
Clearly, it will have to be a combination of organic plus inorganic. And we are going to look at all opportunities that come our way which make sense for us.
Are you also looking at things like McDonald's? The speculation is that perhaps a foray into the QSR space, courtesy McDonald's, is something that you could consider?
I'm not going to comment on that. I'm not going to say whether we are looking at it or we are not looking at it. We've been approached or we've not been approached.
Okay.
I'm not getting into that. The primary focus for us is to really look at the consumer goods space in the FMCG sector or segment.
Okay.
And so we're going to look at lots of products in this, lots of categories, and we're working on a lot of things. And the research our team has been doing is actually coming out with very, very great results.
Okay.
So I think within the end of this year, we should be launching our next range of products, and that's not in the field of snacking necessarily.
Okay.
And there should be a very, very exciting range. Snacking, of course, lots of new products are coming.
So non-snacking space as well?
Also.
Okay. Can you give me some broad sense of what the new categories could be, in which space?
Well, we are looking at multiple spaces, and we will, over a period of time, get into all. So we are looking at personal care.
Okay.
We're looking at Ayurveda.
Okay.
We are looking at, well, these two for now.
Okay, personal care and Ayurveda specifically. Yeah. Okay. So do you believe that this calendar year is when we could expect you to foray?
One of the two for sure.
One of the two for sure in this calendar year.
Yes.
What kind of investments is this going to require?
Once you're used to the power sector and every project is a few thousand crores,
so
this appears minuscule.
Nothing in comparison.
Exactly. So each such thing, I mean, in terms of product development, is not even 100 crores.
Okay.
In terms of factories, so we're just in the process of setting up a very big FMCG snacks factory in Telangana.
Right.
Which will get commissioned in the next 9 months. And the total investment in that is within 300 crores.
Okay.
So, frankly, the investments in FMCG appear to be quite bacha when you look at
power, which is so capital guzzling.
Exactly. Yeah. And then, of course, you have losses to finance.
Right.
And for the next 12, 18 months, you will have losses. But, the whole thing cumulatively is so much lower than capital-intensive industries.
Okay. Just to a quick follow-up question on your foray into the personal care space. What gives you the confidence of being able to break through there? Because it's a highly commoditized and competitive market.
Wait.
Okay. That's all you're going to say?
That's all I'm going to say at this point in time.
So, you talked about financing the losses as far as the FMCG business is concerned, even though the comparison in terms of cash requirements pales when you compare it to the power business. But break even, when do you expect that?
We should be looking at break even for Tuyan by maybe the July, September quarter for next year.
Okay.
And that's the target we've set ourselves. And I think we are on track for that.
Okay.
And each brand will have a different cycle of getting to break even. But for now, this is what the Tuyan plan is.
Okay. Let me ask you about retail now and the retail aspiration as well. Are you looking at adding space aggressively? You have burnt your fingers in the past. So have there been lessons learned from there? Is it likely to be a more calibrated, measured approach? What is the plan for Spencer's retail?
So let me just put it very clearly. We are going to grow very aggressively in 3 geographies where we are big. That's West Bengal,
okay,
Andhra Pradesh, and Eastern Uttar Pradesh.
Okay.
These are the 3 geographies where Spencer's is doing exceedingly well, and we will grow very aggressively in these territories. We are also now going to look at inorganic opportunities, which we haven't looked in the past.
Okay. In these geographies or outside of these geographies?
Any.
Okay.
And in the past, we hadn't looked because we were waiting for Spencer's to actually break even, which it has done now.
Okay.
And therefore, we believe now it's the right time for us to accelerate.
Okay, well, when you say it's the right time to accelerate, give me a sense of what we can expect in terms of how many square feet you hope to add and what the numbers are going to look like. Because I was just looking at the 3-year revenue CAGR. It's at about 7.5%. Industry is going faster than that. So on the back of acquisitions as well as this aggressive expansion that you've got lined up, how much do you intend to improve on this?
I wouldn't like to really put a number specifically, but you will definitely see far more aggressive growth numbers. And as far as Spencer's is concerned, the focus will be on 4 things.
Okay.
One is adding square footage profitably. The 2 is a very strong focus on private label, which brings in much higher margins.
Right.
A very much stronger focus on apparel, which again brings in stronger margin. And the 4th thing is we will look at inorganic growth selectively, not stupidly, not for vanity, but yes, we will be looking at it and there are opportunities.
So let me pick up on both those issues that you talked about. As far as your size is concerned, you're about 1.3 million square feet today, comparison to Reliance Retail at 21 million square feet, Future Retail 16, D-Mart 5.5, V-Mart 2. So there's a big distance to cover, so to speak. So do you see yourself expanding?
We will expand, and we will expand aggressively.
Okay.
And you will see more and more area coming into play. There are properties that we've signed up which will actually fructify in the next 18 to 20 months. Hopefully there will be inorganic growth as well.
Okay.
And
but what about the EBITDA per square foot performance? Because that as well would suggest at this point in time that you need to focus on operational improvements.
We do. Absolutely.
And what are the levers that you could exercise
As
there?
I said, a higher focus on private label, where you make 35% margin as opposed to 18 or 20. A higher focus on apparel, where again you make 35% margin as opposed to 18 or 20. And higher square footage in our chosen geographies, because every bit of contribution that comes in will then go to the bottom line straight.
Okay. So given everything that you've sort of spelt out for us, in terms of opening more stores, in terms of the kind of pipeline of stores that you're looking at over the next few years, because you've gone from 48 stores in 1995 to 300 in 2006, then you shut down stores from 2009, you're about 150 odd stores currently. So what's the store pipeline looking like?
In terms of square footage, we've got, I think, 3 lakh plus square feet opening in this year.
Okay.
And another 2.5 to 3 lakhs in the next year.
Okay.
So that's already 50% over our existing base. And if you have an inorganic option, then that adds to it.
What's the plan as far as FirstSource is concerned? Because you said that you have inorganic aspirations for the FMCG business as well as for retail. What about FirstSource?
Also for FirstSource, we are in the process of, FirstSource has actually done really well over the last 4 to 5 years since we've taken over the company. But there is a long way to go. There is a really long way to go. And so you will see inorganic growth at FirstSource also. So we definitely are looking at acquiring domain-specific companies. Companies which specialize in platforms, which specialize in AI or robotics. And we are scouting. So any specific geographies that you would be scouting in, or no? So you're geography agnostic. But one of the concerns that you'd highlighted was Brexit, and the uncertainty over Brexit continues, and that's a large chunk, 40% plus, as far as the FirstSource business is concerned. So any plans on diversification to sort of mitigate the risk on account of that? Well, I think we seem now that the risks that theoretically could have been there because of Brexit are largely sort of contained. And I can't say 100%, but largely. And but you will see a far more growth-oriented FirstSource than you've seen in the past. And we had engaged McKinsey to do a study for us, and they are in the process of doing the study. There is a clear-cut plan which is now being put into place, and very soon will be put into execution.
So what would be the pillars of this plan that you intend to focus on?
I think you will see us moving into... there was a sense of complacency that the company had with the big win on the Sky account. Now you will see the effort to get more Skies, and to get more wins, and to actually get into the FGT area, which we've been absent from. Mortgages for us has been doing very well. And but we now have to get into the higher end of mortgages, and you will see us doing that. There's a great team at work in FirstSource in the mortgages space. We also have to make some changes in terms of getting more aggressive sales force in place. And so you will see a lot of all this happening, a lot of action.
So I would imagine that the plan that you intend to put into execution, as you just pointed out, is also going to aid margin expansion. So what can we expect with the margin trajectory?
The margin as it stands is at 14%. And this is compared to 5% when we took over the company. We are still not at the top of the industry. So I think the effort will be over the next 2 to 3 years to get to that 17 or 18%.
You talked about acquisitions. We're seeing interesting moves towards consolidation here in the domestic market, L&T going after Mindtree. What do you make of that? And do you intend to play consolidator in the domestic market?
I'm not looking at really a big ticket acquisition in the tech space. For us, it's actually about acquiring domain and knowledge, which can help us get more clients and service our existing clients better. And that is what we are focusing on at this point in time.
Let me ask you about two of your other businesses and about the carbon black business. What we're seeing today is a general slowdown as far as the auto sector is concerned, both passenger cars as well as two-wheelers. Are you seeing an impact on account of that?
Yes. There is a slight slowdown in the domestic automobile offtake for carbon black. Tires have slowed down, and therefore there is a natural reflection on that. But we are making up our volumes by higher exports. There will be an impact, a certain impact for sure. But overall, you've seen such huge improvements in the operations at Philips Carbon that a certain new normal has been arrived at in terms of profits. And so even a slowdown doesn't really impact it that much. because efficiencies are at an all-time high.
But what do you make of the slowdown? And, you know, we've seen it now for the last few quarters. So what's the expectation? You know, when we talk to auto companies, the hope is, and not the assumption, the hope is that post the election there should be some sort of a pickup in demand. What's your own sense?
You know, my people tell me that I think production at tires has picked up a bit in May.
Okay.
And they expect it to pick up even more in June. So fingers crossed.
Okay. You know, since we're talking about consumption, let me ask you an overall question as far as the trends you're seeing on consumption and consumer spending. The sense one gets, again, if you look at sales numbers, is that there is a secular consumption slowdown. Are you seeing that as well across your businesses?
Yes, we are. And
discretionary or?
Discretionary spending is definitely down. We're hoping that post-elections it picks up.
How much has it been hit?
Difficult to quantify, but clearly there is an impact. I think we are seeing that in FMCG sales. We're seeing that in offtake at our retail outlets. So definitely there is an impact.
So the high-value items are slower off the shelf?
High-value items are slower off the shelves. Discretionary spending is getting deferred. So, you know, I think, but hopefully after the elections, it should become better.
Okay. Quick question on Saregama and what the outlook is as far as that business is concerned, and especially on Saregama on the go.
We're very, very excited about Go. So Karma was a great launch and a great product. Go is, as you've consumed it, it's the newest version of Karma. It's literally, it's about this big and you can take it on the go. And we expect that in the past, the bigger Karvas were used for gifting. This product, the Go, will be used for personal consumption.
Right.
And therefore, there is a different market and a bigger market that awaits Go. So we are very excited about it. You will see many more versions of Karva coming out, in the sense that the Karva minis will have specific products. So a Ravindra Sangeet or specific Asha Kishore or Lata Kishore combinations, etc., etc. We've just launched Gurbani, which is absolutely fantastic. Our films on Netflix are doing well. We've just signed up with 2 other OTT platforms for, I think, with one for 12 films this year and another for 6 to 8 regional films. So I think that's another part of the business that's actually looking very good.
Okay.
So I'm fairly optimistic about Saregama. My people in the films division of Saregama tell me that every time you dislike a film, that's me, it does well, and every time I like...
Which was the film that you disliked? The last
Quite
film
honestly,
that you disliked?
I disliked Aji, which did very well and got awards and trended at Netflix. I disliked Brij Mohan Amar Rahe, which is still trending. I disliked Ashcharya Chakit, which is trending. So, I mean, every film that I've disliked from our stable has actually done very well.
So the test for the team is to actually get you to watch the film and then dislike it.
Yes.
So is that what's being done now?
It is, yes.
Are you watching before it hits the market?
Yes, yes.
So give me a sense of, you know, given the fact that you see Carava as well as the films business picking up steam, what's the aspiration in terms of numbers?
It's very difficult to forecast numbers in this because we've made a comeback into the Vidhu Vinod Chopra camp, and we've signed 2 of their next films. We will be signing some more big ticket music acquisitions over the next few weeks. It's very difficult to forecast which music takes off and which doesn't. But what is certainly happening is that we are getting re-rated by the OTT platforms.
Okay.
I think because of the newfound enthusiasm and vigor in the company and the new products and the success of those products, I think we've been re-rated.
Okay.
And that's helping bottom lines.
Okay.
And our new streams of revenue are helping. So no figures, no forecasts, but I think this year should be a definitely significantly better year than last.
Thanks very much for speaking to us.
Thank you, Shireen.
With that, it is time for us to wrap up the CNBC TV 18 special from the RP Sanjiv Goenka headquarters in Kolkata. Thanks for watching.